Before you earn your first dollar, before you see it in your account, before you decide how to spend it, your money already has a history. It has already moved, already been counted, already been claimed by the system. And most people never notice because the financial system isn't loud. It doesn't announce itself. It works quietly, automatically, and very politely. Today, we're going to follow your money before you ever touch it. Not a theory, not a lesson, but a story. And once you see where it actually goes first, your paycheck will never look the same again. Let's start with something familiar. You work. You give time, attention, energy. Maybe 8 hours, maybe more. At the end of the month, you expect a number. That number feels like your money. But here's the uncomfortable part. That number is not what you earned. It's what's left. What you earned existed earlier. Larger, fuller, and then it started shrinking. Not because you spent it, because the system touched it first. And this matters right now because more people are working harder than ever, yet feeling poorer than ever. Same effort, same ambition, different outcome. So where does the gap come from? To understand that, we have to rewind the timeline, all the way back to the moment your labor becomes money. Imagine your salary as a full glass of water. You never see the full glass, because before it reaches your hands, it passes through several checkpoints. Each one takes a sip. The first sip is obvious. Taxes, income tax, payroll tax, Social Security, healthcare contributions. They don't ask you. They don't negotiate. They don't wait. The money never enters your control. By the time you see your paycheck, a chunk of your labor has already been converted into obligations. This isn't a conspiracy. It's just design. Governments learned long ago that the easiest money to collect is money you never let people touch. Because once money feels yours, giving it up hurts. So the system removes that pain by removing the choice. And most people stop thinking about it right there. But this is only the first layer. Now comes the part that's less visible. Your employer. When you hear your salary, you imagine that's the cost of employing you. It isn't. Behind the scenes, you cost more. Employer taxes, insurance, compliance costs, benefits administration. Your labor generates a larger pool of money than you ever see. And here's the irony. The company doesn't feel generous paying you. They feel constrained because from their perspective, your paycheck already accounts for costs on their side too. So both sides feel squeezed. And the system in the middle stays calm. Now let's move your money forward. Your paycheck lands in your bank account. This is the moment most people think they finally have their money. But technically, you don't. What you really have is just a claim on the money. Banks don't store your money in a vault waiting for you. They pool it, lend it, invest it, multiply it. Your balance is a promise. And as long as the system is stable, that promise holds. But your money is already working for someone else, quietly. When banks lend your deposits, they earn interest. You earn convenience, sometimes a fraction of a percent, sometimes nothing. The spread, the difference, is where the system makes its profit. Again, not evil, just optimize. Now let's add inflation. This is where things get uncomfortable, because inflation doesn't feel like someone taking your money. It feels like reality changing. Same product, same shelf, higher price, no villain, no receipt. But inflation is a tax that never sends a bill. If your money sits still, it shrinks. Slowly enough that you doubt yourself. Fast enough that your future feels tighter. And here's the quiet math most people miss. If your savings grow at 3% and prices grow at 6%, you're not growing effectively. You're moving backward, even while doing everything right. Now let's talk about timing. Because timing is power. Your money moves first. The system reacts later. Institutions get access to cheap money early. Governments borrow before prices adjust. Corporations lock in assets before inflation shows up in headlines. By the time the average person feels the pressure, the game has already shifted. This isn't luck. It's position. Those closest to money creation feel inflation last. Those furthest feel it first. And guess where wages sit in that line? At the end. Here's where the story gets strange. You're told your job is to earn more, save more, budget better. But the system quietly depends on you doing the opposite. Spending keeps it alive. Debt keeps it moving. Consumption keeps it smooth. So while you're encouraged to be financially responsible, the economy needs you to keep swiping. Credit card. Buy now, pay later. Low monthly payments. Notice how the price doesn't feel like it matters anymore. Only the payment. That's not an accident. It disconnects cost from reality. And it worked. Now zoom out. Your money doesn't just support your life. It supports system. Debt markets, bond markets, equity market. Your retirement fund is invested in companies that pressure wages. Your bank deposits fund loans that increase asset prices. Your taxes service debts you didn't vote for. Your money is busy, but not always working for you. And the most ironic part? You're blamed when things break. People are bad with money. People overspend. People don't save enough. But saving in a system designed around consumption feels like swimming upstream. Possible, exhausting, and rare. Now let's talk about hype versus reality. The hype says, work hard, invest early. Compound will take care of the rest. The reality? Compounding grows wealth faster when you already start with significant capital. When fees are low, when access is early, when volatility doesn't force you to exit. For everyone else, compounding is slow, painfully slow, and one bad year can erase 5 good ones. Still, the story persists because it needs to. Hope keeps participation high. So what happens to your money before you ever touch it? It's filtered, redirected, diluted by time, rules, and hidden incentives. Not stolen, not hidden. Just moved before you're invited into the room. And once you are invited, the big decisions are already made. This doesn't mean the system is collapsing tomorrow. It means it was never designed for fairness. It was designed for flow, stability, liquidity, continuity. Your comfort is secondary. Here's the final uncomfortable thought. If money is a reflection of value, and your money keeps shrinking before you touch it, what does that say about how the system values time? Human time. Because unlike money, time never compounds. You only spend it once. So the real question isn't, where did my money go? It's this. If the system touches your money before you do, who is your work really for? And when do you stop calling what's left your money